What other things should sellers care about in those relationships other than necessarily money?
This is the million-dollar question in a lot of cases.
And it's an important question too, because obviously money is really important, but people need to think about besides just the money. There's a lot of things that have an impact on not only the selling process or the buying process, but also your future. Hi, I'm David Katch, Chief Collaboration Officer.
And I'm Shaun, CFO and Head of Mergers and Acquisitions. We lead deals at Redwood Services, one of the most prolific investors in the home services industry, where we've raised and closed over 60 deals and $2 billion in total transactions.
We're the guys who get excited about doing deals where everyone wins.
It's not only that we're passionate about it, but we enjoy sharing with the people who benefit from it most, home service business owners.
These are our insights, real, honest, and authentic.
Welcome to Sell Yeah.
Let's get into it. All right, today we're going to talk about different types of buyers. The home services industry that we're in is a very, very prolific industry for acquisitions right now and has been for quite a while. Today we'll talk about who the different buyers are, what sellers should expect from the different buyers, not necessarily the valuations of them, but what they should be expecting from a buyer post-close and how that relationship is started and how eventually it ends. There are so many different aspects of this one. This one I think should be a lot of fun. We both have experience on both sides of it, so let's get into it. So there are two main categories of types of buyers. Let's talk about what those are, and then after that we can get into what a seller should expect from their interaction with each of those separately.
Perfect. So you talked about two main categories of buyers. Those two are going to be, one, a financial buyer. This is usually somebody or an entity like a private equity fund or a search fund or a family office that's investing in a business but doesn't actually already have an investment there. So they're just somebody that's bringing capital and maybe operational expertise or a specific investment thesis to the business. And then the second one is a strategic, which is generally a business that already operates within the industry in some capacity. And so the profiles of both a financial sponsor and a strategic investor are different in the way that they look at the business or a potential investment.
When you talk about a financial advisor, talk a little bit more in detail. I think pretty much a lot of people know what private equity is. What is a family office? What are some of those other structures?
Yeah. So a family office is usually a high net worth individual. Their family has a pool of money that they will make investments out of. And so they would buy a home service business, or they may look at other industries to make investments such that they're just operating a portfolio of private businesses.
When people hear family office, they think it's like, I own a company that has nothing to do with this industry and my office is going to buy your business. That's not what it means.
When Redwood started, we took a lot of money from not from private equity, but from high net worth individuals and family offices to help us start the business because we wanted to have a long-term strategic thought partner and the ability to grow the business under a long-term view of the future. And so, they were a key part of building what we've built today.
What is a search fund?
A search fund, this is one that's kind of near and dear to my heart because I think it's fascinating. But usually a search fund is somebody, usually a young individual, kind of an MBA type, that raises money to go then search for a business to buy and operate. They usually have zero technical expertise, usually lack a lot of management expertise, are doing this for the first time, but are young, aggressive, and hungry and trying to make a name for themselves by investing in a business.
And are you seeing both of these types of strategic buyers in, let's say, the home services industry?
I think the two main archetypes you'll normally see are smaller private equity funds or strategics.
Okay, let's talk about each of those individually. So, let's start with the financial buyers. What are they looking for in a business, and what should a seller be thinking about when they're interacting with a financial buyer?
A financial sponsor is going to be looking for a business that is more robust and investable. So these guys are not going to be industry experts. They're going to be looking to the founder or the management team to operate the business post-close. And so they want to make sure that they have a strong foundation for their investment over the course of time. Financial sponsors are usually going to be investing on a certain time frame, usually a time horizon of somewhere between 4 and 6 years, that they'll then ultimately want to sell the business and liquidate their investment to provide a return to their investors and the fund.
What experience does a seller have with a financial sponsor? What interaction would they have? How much interaction do they have as part of the process? Is it mutual? Is it not? Like, talk a little bit about how that works.
Yeah. So in general, I think the most main factor is that a financial sponsor is not going to have the industry expertise. They may have a history of professionalizing businesses and have an operating framework or an ability to invest in certain areas where they have that are scalable across industries. For example, marketing is a big one that they like to invest in, digital marketing in particular, or a lot of times they have M&A expertise that they can use a business as a platform to invest alongside other businesses to add density and scale, which is part of Redwood's playbook. The seller's interaction with a private equity sponsor is going to be wildly different than it is with a strategic in most instances, specifically depending on if the private equity sponsor requires a rollover of equity or the manager, the owner, to continue on working with the business.
Explain the rollover of equity. What does that mean, and why would a financial sponsor require that or want that?
So rollover of equity means that the current owner is rolling a portion of their ownership interest into the new deal. The reason why a financial sponsor would want that is, one, they view the owner as somebody that is critical to the business and that they want to retain. They want that person continue to operate the business, or they want them to continue to be around the ecosystem or the employees or the customers. They have a lot of the relationships. And so they view that person as just mission critical to what they're trying to create. And rolling equity allows the ownership interest to be aligned. So you're directly aligned with the financial sponsor because you both own equity in the business and you want it to grow.
You want them to have skin in the game, basically.
Skin in the game is an easy way of saying it.
Yeah. They want the sellers to have skin in the game because you want them to have an incentive to grow the business.
Totally. Absolutely.
And they're the ones that are most knowledgeable too. Like, they're the ones that have grown the business to where it is now, and the sponsor has not necessarily been in that industry before.
That's exactly right.
Okay, let's talk about the strategic buyers. What's the profile of those, and what are they looking for specifically in a business?
Yeah, absolutely. So strategics, as we talked about, they already own a business, at least either in the industry that you're talking about or something tangential. So they already generally have a management team or infrastructure or a way of operating that they're likely going to want the seller to integrate into post-close. So they already have a framework for how the business looks. So they are able to invest in a wider variety of businesses, particularly businesses that are less successful because they have the infrastructure to support the team going forward, if that's what the investment strategy requires.
So like in my previous job with ServiceMaster and Terminex, it would be something like a Terminex or a Rollins, Orkin, buying smaller businesses. They would be more of a strategic type buyer.
Exactly. I think that the important thing for a seller in understanding a strategic versus a financial sponsor is, number one, all things equal, a strategic is likely going to be able to pay more for your business because they have the ability to add some level of synergy, whether that's purchasing power. They have the ability to take cost out of the business, which sometimes that means that they're terminating employees or they don't need specific functions like call center or accounting or marketing. They can do that centrally. They also have the ability to add in incremental service lines or cross-sell, so there are revenue synergies. And all those things allow them to be more value additive to the business after the fact, which means that they're willing to pay more because it's more valuable to them after you finish the deal.
Owners should care about different things when they're approaching whether or not it's a strategic buyer versus a financial buyer. What should an owner be thinking about when they're approaching those two opportunities potentially?
A strategic buyer is going to have a lot more thoughts on the go forward management of the business and how the infrastructure looks. They're usually going to have a preferred method of operating and cadence and reporting. They're usually going to have a way that the team will look post close, or what the cost structure will look like, such that they can integrate it into the overall ecosystem. They're likely going to have a more formalized way of doing business going forward because there's already an ecosystem to work within. And so there will be likely less flexibility for the business owner going into a strategic relative to what they would have with a financial sponsor.
And there also may be less autonomy too.
Generally less autonomy. It depends on a one-off basis what the strategy is for the strategic investor. But generally speaking, they will likely have a little bit less autonomy because there's a standard way of doing things, for lack of a better term.
What other things should sellers care about in those relationships other than necessarily money?
Yeah, this is the million-dollar question in a lot of cases.
And it's an important question too, because obviously money is really important, but people need to think about, besides just the money, there's a lot of things that have an impact on not only the selling process or the buying process, but also your future. And, sometimes money just can't solve all the problems.
We like to say at Redwood that you can get your money from anywhere. There are hundreds of buyers in the home services industry, and a lot of them are going to be willing to cut a check. But really what you need to understand as a seller is, who am I ultimately going to be making a deal with and betting on? And do I trust them? Do I agree with the strategic philosophy? Do I think I'm aligned with them culturally? The number one reason I see deals go wrong is that there is not alignment between the investor and the owner and the expectations for the team post-close. That is the number one cause of failure in deals, in my opinion. But there's a bunch of other things that you need to make sure that you're considering. The money is obviously a very big one. But what is my role and the management team's role going forward? What level of say do I have in the business? What kind of governance do I have? Do I actually have a formal voting right in my own business? Do I have control? Some instances, people are investing where the owner can maintain control in the business going forward and be the key decision maker. Do you want to make sure that the brand and the legacy and the reputation of what you've built over time is taken care of? Some strategic are going to rebrand the business as soon as they invest in that. That's something for you to consider. Do I have the customer relationships and the strategic alignment with the buyer going forward? If not, then that might be something that you need to consider in evaluating whether or not you want to do a deal.
And we've seen numerous times where people have taken less money, or at least we've been told they've taken less money, because the relationship with who the buyer is so important to them. They've turned down extra money because they want to be with the right buyer going forward.
Absolutely. We talked about brand and legacy, but the employee experience and how employees are going to be treated post-close is very important to a lot of sellers, as well it should be. And if you're confident that somebody that's willing to pay a tiny bit less money, but that the employees are going to be treated fairly and have future opportunities that may not be available to them right now, that might be worth something to a seller, especially if the employee base has helped them get to where they're at today.
Looking at the different types of buyers, there's a big universe of potential buyers out there. They all have different strategies and different goals. I think the best lesson for people who are thinking about selling their business would be understand who they are, understand what they're trying to accomplish, how you might fit with them best. Do your homework, understand, what their goals are, and do your goals align with their goals? And if you do your research with it, I think you'll find, money may not be the most important part of it. It certainly is a factor, but there are so many other factors depending on the alignment between the buyer and the seller that certainly will have an impact on the deal getting done.
I would highly recommend all sellers do reference checks on the buyers that they're working with, whether that be to former sellers or former business owners that the buyer has worked with. That will tell you a lot about sort of the trustworthiness and the transparency that they're approaching the deal with, and ultimately will provide greater alignment over time, which is what makes deals successful. in a lot of cases.
As we started with, there's a lot of deals going on, and especially in the home services space, there's a lot of activity. There's a lot of buyers. There's a lot of sellers. Do your homework, learn best about the sellers, learn best about the buyers, and hopefully the deals will get done and everybody will be happy when the deal closes.
Ultimately, you can paper a lot of things and structure a lot in deal documents, but trust is the most important factor going into a deal, and it is highly indicative of how an investment is going to perform and an owner's experience on the other side with the business post-close. So just make sure you know who you're getting into bed with and if you believe in that person and their philosophy for running the business. Poor decisions. One beer, one bad deal decision, and one lesson we paid for so you don't have to.
All right, that takes us to our poor decision segment, where we enjoy a beer and talk a little bit about a decision we might have made in our past that may not have gone the way we had expected, but at least something that other people can learn from. So tell us today, what beer are we talking about here?
We're talking about the Traffic IPA from Crosstown Brewing here in Memphis. I like this one because there is no traffic in Memphis, so it's a little bit of a playful type of naming here.
All right, well, let's get into it.
Let's see if you can pour this correctly.
I struggle a little bit with it.
Look at this, audience. David learned how to pour a beer.
Look at that.
It's almost like you knew what you're doing this time.
All right. Cheers.
Cheers.
All right, so Shaun, tell us.
That was still all foam for me.
So this one I think is going to be a little bit difficult because, we are buyers. So, our topic today was the different types of buyers. We talked about strategic buyers. We talked about financial buyers. Give our audience a little bit of a taste of maybe a poor decision that we've made that's related to it, or maybe stories that you've heard that sellers have made that are poor decisions that other people can learn from.
This will be the first time that it's not one of Shaun's poor decisions that we're talking about here, David.
Is it one of David's poor decisions?
No, there's still plenty of those. So this time we'll be talking more about poor decisions that sellers have made. And we had teased it on the front end, but knowing who you're doing a deal with is one of the most important things that you can possibly understand. So we have heard horror stories or poor decisions about owners making an investment in a business, owners selling a business and buyers promising certain things that turn out to not be true. So there's a story that goes around the Redwood offices every so often, which is that the owner and founder of a business whose name is on the wall, who built it from nothing over the period of decades, does a deal with a sponsor that on day one after close kicks him out of his office, puts him in a cubicle, hands him a laptop, and effectively says, "You're now the intern." And he wasn't treated the way that he thought he wanted to be. Yes, he had gotten his check, but ultimately it turned out that it was something that left a pretty sour taste in his mouth because this thing that he had created over time was no longer his and he wasn't controlling it anymore. And he found out that he couldn't trust the buyer.
And unfortunately, it was too late at that point because the deal was already done.
At that point, it is signed and sealed. So it's super important to know who you are getting into bed with.
And doing your homework, understanding who they are, and maybe setting the expectations for what you expect when the deal is over.
If you can't look across the table and say, yes, I trust this person that I'm doing a deal with, you should think long and hard if it's something you want to proceed.
Good advice. All right.
So yeah. If you're interested in learning more about the potential sale of your HVAC, plumbing, or electrical business, or have general questions about the process, feel free to contact me at Shaun@redwoodservices.com or contact us at redwoodservices.com.